mild recession not priced in, could result in 15+% downside. And even in an optimistic scenario of soft landing, upside is likely less than 5%. And that comes through short-term fixed income.
Yeah, well, there is an alternative, right, in fixed income, and this is why we have the problems with the banks and deposits, right, because everyone's shifting out into higher yielding assets, right, in CDs and money markets. So you've been seeing that all year, that there is an alternative now. And I think that's one of the reasons why actually we've seen a trading range in the market. But at the end of the day, you're right, it comes down to earnings, and not all earnings are going to be horrible. I look at energy, for example. Numbers have been going higher, actually, and that sector is well below the 20 multiple that Marco is talking about for the overall S&P 500. Financials, under 1x book. Historically, that's been a great time to buy them. Yes, they have their struggles, but by the way, I thought the quarters from JP and Wells Fargo, even Citigroup, who can't execute consistently, all three of them were really good. And so to me, there are pockets. I think the consumer's hanging in there. We talked about retail sales last week, and I'm looking at the three-month moving average at 1.8% growth. Consumer is still hanging in. Are they going to hang in if we have a recession? Probably not. But as of now, look at the Atlanta Fed GDP number at 2.2%. That actually is not a recession. We're not there yet. So I think that there are pockets in the market. And as you know, I've gotten more balanced in my portfolio, owning some defensives, but certainly seeing some opportunities in the cyclicals as well.
How do you respond?
Yeah, Steph and I are super aligned on the energy sector. Expectations are really low. 2024 earnings are 20% below 2022. I don't think it's a huge inventory problem, and I think demand growth will exceed supply growth. So I agree there.
It's like 5% of the S&P.
Yeah, 5% of the S&P, 11%.
It's not going to be the determining factor.
No, but it was 11% of the earnings. So, I think it's a little chunkier than people think on the earnings front. On the banks, we probably differ a little bit just because I think some of them, I think I agree with you. You're buying below 1x tangible. It's a good deal. But the question is, that's really the intellectually honest tangible, or is the growth going to be lower? So I think it's more mixed there, and I think there's more. I can dream more in other places. I'm probably most negative on industrials.
Now you're picking a fight with Steph.
Well, our work shows industrials now the biggest percentage of the growth universe they've ever been, and I think about mistakes I've made in my career. The dozens and dozens of mistakes I made, most of them, or a lot of them, are when I confuse structural for cyclical. And, you have an upward slope, you have a cycle over it. I just think maybe some of these things are over-earning. We haven't seen the slowdown. Sure, there's exceptions if you've got great exposure to agriculture, oil, and gas, and you can grow above GDP. But there's a lot of sort of widget makers trading at 19 times with high earnings expectations. So I think it's always, Steph's a stock picker, so I think it's always in the details which ones you're talking about. But I think in aggregate, I'm looking, if I compare to energy, I'm looking at high estimates, high inventory, high valuation. So I like that pair trade. They both benefit if everything's, reopening, and both get hurt if it's not. But I kind of think energy's a lot cheaper.
Steph, I mean, you are one of those who try and tell a more positive story around the industrials, albeit on a bit of a selective nature, but nonetheless, far from a sky is falling scenario in that group.
Yeah, well, as you know, in the last couple of weeks, I sold CAT and I sold Deere. And so I only own Boeing, GE, and I own Ingersoll Rand. And I've been adding to Ingersoll Rand over the last couple of weeks because I think it's a great play on onshoring. Boeing, you know why I like it. I think longer term, they are going to get their act together with the 737 MAX. For the most part, they have. They had a little bit of a stumble on Friday, but I think they'll be fine. Free cash flow is going in the right direction, higher. And GE is a play on that, given their engine. So it's very specific within industrials. But as you know, I sold some industrials and put it into a more balanced area like staples, like P&G and Keurig Dr. Pepper. Back to earnings for a second, Scott. I actually am in the camp that earnings are going to be better than expected. And that means, is that better than feared? Okay, I'll take that. I'll give you that, whatever. But to me, I think margins are going to hang in better than expected. Everybody is gloom and doom on margins. We know companies cost cut all the time. We know that a lot of them have pricing power. I think international growth is going to be stronger than expected and much more of a tailwind. And the dollar being weak will also help multinationals. So I think at the end of the day, earnings will come in a little bit better than expected. They're not going to be up double digits. I don't want to suggest that, but I just don't think they're going to be down 9-10% like some people are expecting. And that's why I look for opportunities.